Hello, friends, colleagues, and clients. Today is Monday, September 20th. My name is Richard Siegel with ARQ Wealth Advisors, and we're going to do a quick market update. Well, if you had the TV on today at any point in time, you could see that the market really plunged quite a bit. In fact, at one point, we were down about almost 1,000 points on the Dow, only to come back a little bit at the end of the day. So just for perspective, we have four indexes right here. I wanted to kind of show how far off of their recent all-time high levels. So from the peak to today's bottom, the S&P finally got down below 5%. The Dow, 5 2/3. The Russell 2000, which is small cap stocks, down about 8 2/3, and foreign stocks, which would be a blend of both developed markets and emerging markets, down about 6 3/4. So definitely a pullback, nothing major. In fact, the technical definition of a correction is 10% or greater. So that being said, we would not be surprised to see a little more on the downside here, and that's fine. We don't try to avoid all corrections. They're going to happen. That's normal. We do try to take risk off and plan for major bear markets, which could last for a long time, years in some cases. But short, intermediate term corrections, 5, 10, 12%, it's almost impossible to prepare for those, to plan for them, to time them. So our goal as fiduciary advisors is to allocate your portfolio so that you could weather those types of corrections and volatility and come out the other side in short order unscathed. There are a few things here the market's worried about. Number one is the debt ceiling. This seems to happen every couple of years. If the government was to fail in extending the debt ceiling, we could have government closures, shutdowns, partial shutdowns. It's pretty fascinating. History shows that when that happens, the market actually does well or flat. The market does not seem to care that the government can't get their act together. Two would be tax increases. The Biden administration and Congress is working to create a bill that would increase taxes on high earners and successful small businesses particularly, and also moderate increases to corporate taxes. Joe Biden ran on tax increases. This should not be any surprise to anybody. In fact, if this were to go through, it looks to be much more moderate than anticipated. There's some turmoil in China. That's one of the downsides to investing overseas, especially in the emerging markets space. There are some risks there related to government controls. That being said, we are exposed to emerging markets. Our clients are probably exposed 1.5%, maybe 2% to China. So it's not a huge exposure, not a lot of investment there. And as we've discussed in many other communications, parts of the market are expensive, especially large cap tech, trading at valuations in the 30 times earnings range. So some of the air does need to come out here. On the plus side, valuations are attractive in other parts of the market, 15, 16, 17 times earnings, mostly in the value space, industrials, materials, financials, etc. Value stocks had a great first part of the year and have been kind of lagging since. We feel it's most likely going to be the case that once the Delta variant starts to really roll over hard, that the value sector should outperform once again. There is still about $5 trillion in cash, both institutional and retail money, that is earning zero, while inflation is currently at 5%. So cash is basically losing 5%. That money will find its way into the risk assets in the next couple of years. So we feel that any type of pullback, 5, 10% pullback, really does attract money off the sidelines, which is good for stock prices. Cash is earning zero. And the 10-year Treasury bond is yielding about 1.3. So really, to make any money at all in today's capital markets, it has to be in risk assets, i.e. equities. Lastly, corporate earnings are incredibly strong this year, probably over 40% year-over-year growth for the S&P, while the S&P is only up in the teens. So the bottom line is earnings are greatly outpacing the performance of the stock market. And when that happens, price to earnings ratios come down. In fact, they have come down quite a bit. We're looking right around 20 times forward earnings today, where if you were to look at other parts of the markets, again, in the teens, which is right around historical averages. Chart here I thought was pretty neat. This is a year-to-date chart of 4 benchmarks. The blue one, the top, is the S&P 500. And you can see it's rolled over here pretty hard, okay? The next two, the purple is the Russell 2000 index, that's small caps. And you'll notice how tremendous the growth was in the first part of the year. And really, it's kind of done about nothing since the spring. Very volatile. The light blue is the Dow, right alongside the Russell 2000. And this pinkish color here is foreign equities, both developed and emerging markets, up about 7% for the year. So what you'll really notice is that the best performing index for this year has been the S&P 500, the blue here, okay? But also the most expensive index possibly in the entire world. And the reason for that is because the top 10 stocks in the S&P 500 have a very high valuation, and they're loaded in those big name tech stocks that we have discussed in the past, i.e. Amazon, Google, Facebook, etc. So again, just to kind of reiterate, we do think we are in a period of some turmoil. September, October are usually pretty volatile months, kind of getting ready for the best part of the year, typically in the November, December timeframe. We are using this volatility to deploy capital for new clients or new money. And we have already rebalanced portfolios for the quarter, selling high and buying low. So basically we have taken off some risk in client portfolios in the last few weeks. With that, we'll say goodbye. Have a great day and be well.